From our world headquarters in New York, Bloomberg Surveillance, we welcome all of you nationwide, across Canada, around the world. This hour brought to you in New York by First Republic Bank. And speaking of New York, Tobias Levkovic with us of Citigroup. We'll talk panic euphoria, but first, you were at Yankee Stadium last night, not in the rock star seats. What did you observe, panic or euphoria?
I would say kind of panic around the eighth inning when everybody's pretty much left, and then they kind of gave you an exciting ninth. You were late to your appointment today. It was a little ugly, huh? Oh, it was exciting by the bottom of the ninth.
I'm surprised that your famous panic euphoria model, whatever that is in neutral territory. Isn't there like an effervescence out there? We talked to Laszlo Barini earlier this week. There's this ferment out there of optimism, and yet you're neutral.
Well, if you look at our panic euphoria model, what it really tries to capture is not just how people feel, but how they're positioning in their portfolio. So what I would say is people have been grudgingly capitulating to this rally, but there isn't a real great ebullience out there. What we saw was back in July, when the market started having trouble in June, people actually got positioned back into a defensive mode. We slipped into panic, and around mid-August, we moved into kind of neutral territory. What really drove it a couple of weeks ago was the investor intelligence, the American Association of Individual Investors surveys. Those things really soared.
But when Tobias Levkovic says people, do you mean our viewers buy in 200 or 1,000 shares? Or when you mean people, do you mean the big institutions that were, say, 9% in cash? Oops, I got to get to 4% in cash?
I love questions that you go, this or that, and you can answer yes, because we actually capture both.
We're very good at that here at Bloomberg Surveillance.
Well, we capture both. We look at, for example, retail money market funds to see what they're holding. We look at those survey data that pick up individual investors, but we also pick up things like put-call spreads, the premiums that people are willing to pay for those put-call spreads as well, and that tends to be much more institutional.
Earlier this morning on Bloomberg, The First Word, we were talking with Justin Urquhart-Stewart of 7 Investment Management in London, and Justin says when he steps back and looks at the U.S. market and looks at P/E ratios, as he put it, there's plenty of P and not enough E. Is that the way you see it, too?
No, not really. I think if you think about where you are in a business cycle, it's going to affect that PE pretty substantially. If you're at trough earnings, you don't want to take you're going to have high PEs naturally. When you're at peak earnings, you're going to have low PEs. So I used to be a cyclicals industry analyst. You wanted to sell when they had 7, 8 PEs, which people will say, wow, those are cheap. And you wanted to buy when they were infinite, when they had no earnings off the bottom of a cycle. What we tend to do to adjust for that is we look at normalized Ps, where we take the Professor Schiller's method of 10-year average historical earnings and then put a P, and on that basis you're looking at levels that were late 70s, early 80s. If you adjust for interest rates, you're probably looking at early 60s type Ps. Not aggressive at all.
Yeah, so if you bought them back then and kept them,
you did pretty well.
Yeah, you could have put up with some of the upsets we've seen lately. So when can you see sales starting to pick up? And we had this company after company after company in the second quarter. Profits may be better than Wall Street predicted, but it came from cost cutting, and sales just aren't there yet. So do we see it here in this quarter, fourth quarter, first quarter?
I think it's in the third and the fourth quarter. You're going to see what investors typically miss is that sales isn't necessarily the retailer sales at the end or the privately held auto dealer selling a vehicle to you and I, but rather the company selling it to the distributor network. And production is kind of a better way to think about sales. Production was extraordinarily weak as companies destocked at a very, very aggressive pace. They're moderating that destocking process, but they're still destocking. And I think you'll see some restocking probably more in 2010.
Just to back up for a minute, what you were saying is when Ford Motor Company ships a Mustang to one of its dealers, that's a sale for Ford. Even though it may sit on the dealer's lot for several weeks, right?
And similarly, the steel company selling the steel, the aluminum company, the rubber company, the glass company, the paint company, they're selling it to the auto manufacturer. That's their sale. When you're cutting inventory and you're cutting production, those sales don't happen either.
Okay, so we're seeing that now then.
Now it's changing over, right?
If you're just joining us, folks, Tobias Levkovic of Citigroup with us this half hour. You're big on the Capital Group. You say 2 standard deviations below norm. Is John Deere a Capital Group stock?
It'll be farm and construction machinery, it'll be engineering, construction companies, defense, aerospace. There are a lot of companies.
I mean, if you look at like 20-year trend on John Deere, we're below trend. We've come back a little bit. It was a 2 deviation move down. How up is up for the Capital Group?
Well, capital goods are one of the 24 industry groups. We found some of the, for example, diversified financials will fit in the same game. Insurance will fit in the same game. Things that are sitting 2 standard deviations below their average trading relative to the market. And usually you get wild outperformance or underperformance for about a couple of years. So this could last, in our minds, over the next 6 to 12 months, certainly.
I mean, again, in looking at price to EBITDA on John Deere, 5.40. I mean, is there an EBITDA benchmark, the earnings that you look at where you just say this stuff is cheap like we've never seen it?
I'm probably one of those people in Wall Street who doesn't spend a tremendous amount of time looking at EV to EBITDA, the so-called...
It's because you're out of too many Yankee games.
You guys want to define that? Excuse me, before we go,
sure.
Our audience has more than just accountants in it.
Really?
Define that term.
We have more than an accountants watching and listening to Bloomberg.
So,
I didn't know that. Earnings before interest and taxes, and then you pull over from the balance sheet depreciation and amortization. Did I get that close?
Yeah, enterprise value divided by operating profits before interest.
Oh, no, we're not going to
NOPAT
this morning. Ken will throw a brick at me. Yeah, Rich Truman said he's got a fog in the control room in there.
But basically, when you think about these, what are enterprise value to cash flow multiples, what you'll tend to see is people say, well, think like an owner. This is exactly somebody who would own the business would do it. But remember, if you own the business, you actually have some sort of control over how that cash flow is being utilized. In the case where you're a minority shareholder, which is most of us, I don't think it's such a great valuation. If you're going to go out and buy the entire company, that's one thing. If you're buying just a small piece of it without control, I'm not a big fan of that. Just
before we go to break here, Tobias, and we'll have you back, this idea that we saw last quarter of tepid revenue growth, cost-cutting, surprisingly good earnings growth, do we redux that in this third quarter?
I think we're going to see better revenue growth. We'll see strong margins as well. That'll probably continue in the fourth quarter, possibly even to the first quarter of next year. All of our lead indicators are telling us production rises and margins go up.
Does Bob DiClemente's 2% plus GDP for next year, does that give you enough oomph to make the ship go forward?
I think it does in the first part of the year, just in the sense that you're going to run into some tougher comps by the second half, simply because the second half of this year you're going to see these production upticks.
Now, Tobias Levkovic, we'll continue this. What's the group you like least?
We like telecom, utilities, even healthcare, fairly defensive.
Healthcare.
Fairly defensive.
Is this because of healthcare reform, or is it just because they've moved?
It certainly carries in there. The healthcare reform is an aspect, but it's really around valuation. It's around earnings revision trend. It's, by the way, pharma and biotech as an industry group has the highest percentage of buy ratings of any group in the S&P 500 right now, which may surprise most of your listeners.
I'm going to do a data check here with Tobias Levkovic. Folks, futures, they're worse since Tobias opened his mouth. -3. Dow futures at -24. 10-year yield 3.43. 2-year yield higher. We got a mixed yield curve. 2-year yield 1.05 and 2's10 spread 238 beeps, really flattening out in the quiet here of August. Oil below $72, $71.76 a barrel on oil. Gold $948 an ounce. Ken, it's a struggle to do a data check when not all that much is going on.
It looks like a pretty quiet day. Dow up all of 30 points yesterday. Some of the news you need from around the world this morning. NASA says the Space Shuttle Discovery will launch on Friday after a valve malfunction led the agency to abort today's planned takeoff. The problem earlier this week was the weather. Senator Edward Kennedy has died after a year-long struggle with brain cancer. Edward Kennedy was 77. North and South Korea holding their first talks in nearly 2 years aimed at reuniting families that were divided during the Korean War more than half a century ago. Bloomberg's John Bascom will have more on these stories coming up in just a few minutes. In sports, Yankees and Mets both lose, and Mets pitcher Johan Santana will have season-ending elbow surgery.
You wonder if that just happens instantly,
but
or
not Tommy John surgery. So
not Tommy John. So I didn't know that. Very good. More with Tobias Levkovic. It's Bloomberg Surveillance. Folks out on Twitter, Tom Keene _. I'm talking about Tobias Levkovic, his optimism on capital goods. You can see us on Twitter, also on Facebook at Bloomberg Surveillance. And Tobias, I was just talking about Gene Munster, who was with us yesterday from Piper Jaffray. We talked about John Deere. What about the Apples, the Amazons, the Googles of the world? They're 4 times EBITDA. They're rich. Is there any enthusiasm there that we heard yesterday from Gene?
Well, a number of places we like. One is this whole industrial commodity energy complex tied to credit conditions, usually being a very good lead indicator, about a 9-month lead indicator for those stocks. So we still want to stick with those. Within technology, we do like the software and services area. So some of the companies you mentioned would kind of fall into that category. The problem, the area that we're probably most concerned about there is semiconductors right now. Earnings revision trends hit almost 90% to the upside. Usually don't get much better than that. And if it starts to roll over, as it seems it might be, the stocks tend to slip with it.
Yeah.
Our guest is Citigroup's chief U.S. stock market analyst, Tobias Levkovic. It is 7:53 on Wall Street. I might have said 5:50 a couple of minutes ago. We're reviewing the bidding.
Feels like 5:50.
Maybe to you.
Yeah.
7:53 is the correct time here on Wall Street. Well, Tobias, John Deere came up in the conversation, and that's in part a commodities play. Agricultural commodities. Every other commodity seems to be running up here. Is it time to play that, or are those already come and gone and you need to find something else?
I still think you want to be in that area for a couple of reasons. As I said before, credit conditions typically lead these trends by about 9 months, so you want to be part of that. Credit conditions have come in. We've seen, for example, junk bond spreads at about 1,000 basis points in the last several months, so that's a good lead indicator. Number two, the dollar is likely to weaken further. Our Forex guys believe that, and generally speaking, when the VIX comes down or when you see volatility coming in, safe haven status, the dollar tends to slip away. Also, commodities tend to be inversely related to the dollar.
So your Forex guys say the dollar is going to weaken further. Does that mean less risk aversion?
That's not why they're getting there. I think when you look at the currency market in general, it tends to be a lot more technical. But we're saying there's a VIX relationship.
20
there.
seconds here. Are we going to have fun in September? Is vol going to come in even further? Complacency set in?
We're more worried about September, October timeframes for a lot of reasons, and could include things like swine flu, 2010 earnings expectations.
Swine flu.
Yeah, kids
What's the
coming back to
EBITDA on
school.
swine flu? Tobias
I have no
Levkovic,
idea.
thank you so much for coming in today with Citigroup. Optimism on capital groups. A bit of caution there, I heard, on September as well. Robert Schiller with us. We had Carl Case yesterday. We're going to round it out, Case Schiller, with Bob Schiller of Yale University. Also, we're looking for a statement by the president on the passing of Edward Moore Kennedy. Ken?
S&P futures down 2 points. Futures on the Dow down 15. Fair value indicating the S&P will be down about 0.3% when the opening bell rings in 95 minutes. And futures on the Dow down, indicating a decline of about 0.2%. 10-year Treasuries down 1, yielding 3.44. The 2-year 1.05. T-bills at 0.15. You're listening to Bloomberg Surveillance on Bloomberg Radio and TV.